quiet start, but getting busier. Got a few earnings coming up later this week, but CPI looks like it's going to dominate this week.
Yeah, obviously, we're coming off the back of that, slightly softer non-farm payrolls release we saw last week. But ultimately, we kind of saw the bid in Treasuries fade into the close on Friday because they know that this CPI report is looming large. If the Fed is to do anything, it's very much going to be off the inflation mandate, not necessarily the labour markets, given that inflation has been running above target for about 5 years now. And, I think in terms of kind of how the market will trade it, I think there's probably a higher sensitivity to a hot report. We saw that FT report last week suggesting that Walsh is going to look to reinforce the messaging on inflation. So that does potentially set us up for a slightly more hawkish Jackson Hole. In terms of where market pricing is at the moment, it's a relative coin flip between whether they do or don't go. So you do feel that one way or the other, this will tip things to some extent. Of course, we still do have another report by the end, before the upcoming meeting. But in the event we do get a call report, obviously, we'd expect to see a bid in Treasuries, but events in Iran could potentially put a bit of a cap on that.
Well, on Iran, $83 a barrel right now, 83.47. You're down a tenth of a percent on Brent. Is this a market that only cares about the extremes, the completely reopening, or a return to significant conflict? Because right now it's just been bumbling around that $80 to $85 level. In fact, over the last 2 weeks, oil is a little lower, and we've seen the gains in the last 5 days or so, and currently around 83. How important is the current status quo for the inflation story?
Yeah, I mean, if you look at since the start of July when things really broke down, we've kind of done this 70 to 100 range. And as you mentioned, we're kind of in the middle of it, kind of middling. I think on the short-term bias for oil is probably upside in the near term. If you look at the 10 of news flow over the weekend, you've had Iran say no direct talks to the US. We've seen a security shake-up. We've seen even reports that Khamenei's now on the scene. I think, you could potentially get a jolt lower this week. It looks like the next thing is potentially this Iran-Oman deal. But ultimately, that could probably be a bit of a short-term move because it won't get the Strait reopened. And the market just really cares more about whether getting a more durable US-Iran deal. And even then, though, for assets, the bar to reprice anything more optimistic is a relatively high one, particularly if you look at European government bonds. We saw in Sintra, even when things were looking better, the ECB was still particularly cautious. So that does definitely place a cap on things.
OK, I'll just finish up quickly. We're watching the yen quite closely, obviously. It's not gotten a huge gain from that weak non-farm payrolls report. Is the path of least resistance still towards a lower yen and higher dollar yen?
Yeah, I think so. I mean, if you look at the price action today, we're above 150 and we're going. Yen's the worst performing G10 today. It's worst performing G10 this month. Even euro-yen, in which the transactions were conducted, that's moving higher. So the market's verdict appears to be, yes, it caused a bit of a short-term demand jolt in dollar-yen, but at the moment, they're happy to keep reloading up and buying a dip in dollar-yen. And I think if we get more of a runway whereby the market is like, oh, this is it for the yen, for the latest intervention efforts, then this momentum can keep moving to the upside, particularly in a world where the BOJ isn't really doing a great deal and the Fed is still priced hawkishly.
Adam, thank you. Bloomberg Markets Live's Adam Linton. Remember, you can get up-to-date analysis and insight from Adam and the rest of the team. Just go to MLIV Go on the terminal.